Okay, folks, I thank you for being patient. Those who've been on my webinars before know that an occasional starting glitch is not unknown, and we will not dwell upon the reasons for that. Most of them probably have to do with me, but why dwell upon it, as I say? So let's get started. The topic today is one that I find one of the most interesting and fascinating in foreign exchange, in all trading in general, actually. All of us, from the top to the bottom, let's find a good chart here to illustrate this. I'm going to start with the euro chart, actually. Let's the euro. Okay. Now, volatility. It's something we all both crave and fear. Volatility is the basis of profitability. No movement, no trading, no profits. Volatility is sometimes predictable, sometimes unpredictable. But it is something that every trader must at least master in their approach in order to be consistently profitable. Let me just take a look here and see where we are. By the way, anyone who has any comments, criticisms, jokes, or any other comments, please just type them in. I'll be glad to stop and answer them, or at least respond to them as best I can. In the foreign exchange market, we look at volatility, many of us, certainly on the retail side. I'm more than happy to listen to jokes, especially because I'm very bad at telling jokes. My kids, who are 4.5-year-old, I think, are better at telling jokes. I could tell you one of them, but it's not funny, and we don't have that much time. They're really good at knock-knock jokes. I will tell you one. Their knock-knock joke is, knock, knock, who's there? Orange. Orange who? Orange banana. That's the joke. If you have 4-year-olds, I guess it's funny. Sorry. Volatility is something that we all have to cope with. It's something we all desire, but we sort of prefer it in a measured fashion. Well, that's exactly what we don't get most of the time in foreign exchange, because if it's a measured fashion, that means everybody's on top of it, and everybody knows what's going to happen, and basically nobody's going to make much money. It seems from the retail side that volatility descends from on high. And that's actually not a bad analogy, because the way the market works. Now, let me give you a little bit of my background so you know that I am not speaking theoretically here. Those of you who have been to my webinars before have probably heard this slight bit of introduction, but I think it's useful because it does very much pertain to the topic that we're talking about and the origin of volatility. I'm actually going to give some dates here, much as that embarrasses me, I think. It doesn't actually embarrass me. I started trading I started working for Credit Suisse in 1988, right out of grad school, here in New York City. In those days, the foreign exchange market was relatively new. It had officially started in 1973 when Nixon took the U.S. off the gold standard, but it took a long time to really get rolling. Banks had always traded foreign exchange. They always had to exchange trade flows, but before that, they had pretty much done them at fixed rates. I remember an old trader telling me once that we used to trade foreign exchange by mail. By mail? By mail. Because the rates didn't change. There was no volatility. It was a fixed rate system. Unhooking the U.S. from gold meant unhooking the U.S. from its value. So value had to be established in another fashion. Well, if value's not set, what do we use in capitalism to establish value? We use a market. Something is worth, in the cliche, what someone else is willing to pay for it, and vice versa. That's what happened in foreign exchange. But how? Technically, how do you do this? You can't do it through the mail anymore. So what evolved was a system of voice brokers. And this is what used to be the foreign exchange market, where the brokers all sat around a table. Each one of them had 4 or 5 banks on the line. They shouted prices across the table, hooked up to the bank traders on the other side. So if I said, say the market's trading 5.10 and whatever, I would tell my broker, I've got 5 to go at 10. And he would shout across this table. And I've been in some of these broker rooms in Sydney before, they were put out of business by The market's not chaos. Let me tell you. This is why I'm going through this, because it actually, I think, is very instructive to understand how volatility gets generated and how prices get generated. So they would be sitting around a table and they'd be shouting out prices. And so if I was offering 5 and somebody else across the table had a banker on the line that wanted to buy them at 10, then they would do the deal, and I would get their name and he would get my name. That's where it came from. Needless to say, this is a voluntary system. So if there's no one putting in prices because they don't know where it is, there are no prices. So it was the job of traders like myself and others at the money center banks to provide pricing to the system. That was our job, dictated by our banks, not by some regulator. There were no regulators. This was all interbank, and it was all unregulated. The banks dealt with each other. The banks had credit lines with each other. You netted out at the end of the day. That's a position you're allowed to carry if you were allowed to carry. Most of us did not carry positions overnight. But the system was entirely voluntary. It remains entirely voluntary. It's not mediated by voice brokers anymore. And that was a stressful job if ever there was one for those voice brokers, because not only did they have to sit all day on a round a table screaming, but then they had to take all the traders out every night, and they all had 4 or 5 traders they were out every night. A lot of those guys did not last very long in the business. However, that's a different story. This became intermediated rather than voice brokers by EBS. But again, EBS, which stands for Electronic Brokering System. It essentially looked just like our trading system. You saw prices on a screen, a bid and an offer. The difference is everything was voluntary. So I would sit at a terminal, my EBS terminal, and I would type in a price. The market was 510, and I wanted to sell at 9. I would put in, say I'm dealing Swiss francs, 5 or 1 or whatever amount I wanted. Usually the minimum was 1 at 09. I'm tightening up the market. I'm offering to sell. Now, 2 things are happening, of course. Not only am I tightening up the market, but I'm also indicating that I might have more to go and the market might go lower because I'm going to pressure it down. So these are the kinds of information that traders had to deal with. It's still the same now. Although there are more electronic players now, the process is exactly the same. This is where your prices get generated from. Now, many of you probably know this, but I'm just doing this for the people who don't. So the top level of the markets is still the same. Now, retail trading has come a long, long way, but it's still nowhere near as much volume going through retail trading to really affect the market. Because remember, some firms are straight through, some are not. But either way, the amount of volume is relatively low compared to the trillions, which the last thing I saw, the market actually come down, but it was like 3 trillion a day in volume. Now, most of this volume, 95%, is speculative volume. It's not trade flows. It's not Toyota repatriating dollars from the United States or Apple repatriating yuan from China. That's not where the flow comes from. The flow and the market movement is speculative. It's what you're doing. It's what I'm doing. We're all doing the same thing. So this is why you often get uniform responses from the market. Because the guy sitting at AIG, I just know somebody went to work at AIG. Somebody told me a joke. Remember AIG, the American insurance company that wrote all that insurance on MBS paper? And the joke is, AIG, I didn't know they were still in business. All right, it's not a great joke. Like I said, I'm not good at jokes, sorry. They're all trying to do exactly the same thing, which is make straight trading profits. They all have the same information. They're looking at charts. This is a chart in the euro going back to 2006. I thank you for that, even though I know it's not true. So the volatility is generated from a universe of traders, men and women, young and old, or probably tending towards the young, trying to do the same thing. So I've always thought that this is the best way to approach the market. It is not an alien entity. There is no market. I've spoken about this many times, I know, so forgive me if you've heard it before. There is no market. There's someplace, a big beast underneath the street dictating prices. The market's all of us. It's the old pogo line. We have met the market and he is us. This is true. So it is the best way to approach the market's psychology is through your own psychology. Okay, that's on that. So the market prices are still generated, by and large, from the bank traders. And the market prices are voluntary. If for some reason at one time, and it's always statistically possible, although not likely, no single trader in the world had anything to do, the price would disappear from EBS. Now, firms like ourselves, which use algorithms to create prices, would still have prices. But EBS, in that theoretical situation, would display no prices because the prices are voluntary. Okay. Knowing that the prices are voluntary, that means that when you see volatility, the basic reason, is because people, traders, are not sure where the market is or where it's going. That's the basic reason. What happens is prices disappear. And there can be many reasons for this. I'm going to go over 3 specific situations, different types of volatility. You don't usually hear volatility classified into different types. Oh, the market was volatile or it wasn't. But there are specific types of volatility. There are volatility caused by different things. And you as a trader should have a different response depending on what generated the volatility. Now, you can't always tell. But to a degree that you can make an educated guess. After all, trading is nothing more than 2 things: educated guesses and money management. That's all of trading. Everything else is secondary. When there are no prices, and this can stem, again, from a number of reasons. What you'll see sometimes, let's take one example. When the market opens in Auckland, I used to trade that market. I used to run the Tokyo shift for Credit Suisse and also for the Bank of Bermuda. Now, most of the time, if the market closes at 45.50 in New York on Friday, it opens up at 40.50 in Auckland. Remember, in Auckland, there are only 3 or 4 banks. Some of the Sydney banks are in. It's the way it used to be. I mean, I haven't been on this desk for 10 years. There are probably more now because the Internet is so much more interconnected. And so anybody who really wants to go on, including you and me, can get on the market anytime that it's open, anytime anybody's making prices. There's absolutely no reason the market can't be open on Saturday and Sunday. It's just a matter of somebody has to sit down and put in prices to generate the market so that a deal can get done. If you look on your trading system, Saturday afternoon, Sunday morning, you'll find the price there. It's just that it doesn't move. Because what you're seeing is the price from Friday, and that's still out there. So when the market opens on Monday morning in Auckland and Sydney, and there are probably some Tokyo banks in, and there are probably some American and European banks in as well. Lots of banks used to have 24-hour desks. It's a little tough on the traders. We have a 24-hour desk here. It's a little tough on the traders because there's nothing quite as disorienting as a permanent graveyard shift, but such is our world. So if nothing had happened over the weekend, then the prices will open up a little bit wider, and then as more banks come in, more people put in prices. Remember, the reason the prices are wide is because somebody sitting in Auckland, Bank of New Zealand, has got a price out there. That means you put in a bid and an offer. Say it's one guy putting in, or one girl putting in, one woman, it's usually men, putting in 2 prices. So if he's 40.50 on EBS, that means in the euro, he's going to buy at 40 and he's going to sell at 50. Well, that's his price. That's his book. That's his P&L. So it's important both to him and his profits and to his bank that these prices don't generate a great deal of risk. So most of the time, very little happens over the weekend, but not always. Sometimes, and I have witnessed this many times over 20 years of trading, 15 years of active bank trading, actually, something does happen over the weekend. It's not, Joan Rivers got married again. You shouldn't encourage me to joke, because then I'm going to make more jokes, and none of them are going to be funny. But I remember one time, especially when the ERM was out, this is the late 90s, when the Europeans, or the mid-90s, when the Europeans were attempting to move to, they had already signed the Maastricht Treaty, but they were attempting to move to a single currency. What they tried to do was to lock all their currencies into a specific band of trading, much as the Chinese do with the yuan, the Singaporeans do with the Singaporean dollar, and many other currencies as well. They're managed currencies. Well, the trouble is the Chinese have a very tight control over their currency. You can't get any yuan except from the Chinese. That was not true under the ERM. So they were attempting to control trading without having the necessary tools. Because you could have a sterling account anywhere around the world. There was no control over it. This is, of course, the Soros episode. So one morning, one Sunday afternoon when I come into work, I forget what exactly had happened, but the ERM currencies, the Belgian franc, the French franc, the Swiss franc, the sterling, there was no euro, were all going bananas. And we sat with an order book with hundreds of orders in 15 or 20 different currencies, watching the markets go crazy. We also had responsibilities for making prices. So when we started trading that morning, prices were 100 wide. It would be like going to the euro, and you have a price in the euro. What is it? Well, it's 28.29. A customer would call me for a price out of Europe because they knew something was going to, and I would say, well, I want a price in Swiss franc, and I'd say 124, 125, and they said, what? I said 124, 125. That means 124, the big figure, 125. Why did I make that price? Because I didn't really know where it was, and I was pretty sure he was going to deal. So you get that type of volatility. That's one type of volatility. Okay, let us actually, before we, and I know I have a tendency to get a field here, and I want to make sure that we actually go through this. So I'm going to go through the types of volatilities that I have charted out. This is actually a fascinating topic for traders because it matters, as I said earlier, for your trading decisions. If the volatility that I just mentioned was caused by a permanent change, say, in the Swiss franc, because dollar Swiss is quoted on the dollar side, so 124, 125, that's the dollar price. Now, if the Swiss, and this number of central banks did this, over the weekend, if people were speculating in the Swiss franc, speculating that it's going to go down or up, but let's say go up, okay? That means the dollar Swiss krone would go lower. Say there was turmoil in the world, just as now. People will go to a safe haven. The Swiss have been doing this with the euro. This is a very current topic. Remember a year and a half ago or 2 years ago when the Swiss came out and said, we're not going to let the Swiss get any stronger against the yen than 120? And they were out there and they were intervening and they were there at the floor? Same thing. If they had come out with, let's move this to the modern day, rather than my own personal history. If the Swiss had come out and made that announcement over the weekend, it would have had a profound effect on the markets when it opened on Sunday night. And quotes in the Swiss franc would have been very, very wide, especially on the side opposite what the Swiss bank is trying to do. So this is where volatility comes from. Okay. Now, I have listed what I call three types. So let me just read you this. These are things that can reach different types of volatility. I take it from the what I actually wrote up for this. It says Bernanke. Let's take these three thought experiments, possible scenarios. Bernanke says suddenly, maybe after having a very good dinner with an excellent bottle of wine or two, that quantitative easing is going to end tomorrow. There would be a profound move in the euro and the dollar. Another example, non-farm payrolls is expected, say next month, is expected to be 190,000. Instead, it comes in negative 400,000. we're going to get a huge move. Another one, sterling suddenly reaches a 4-year low and then suddenly accelerates because of stop-loss execution. These are 3 different types of volatility, and they illustrate what I call, or I'm going to categorize as, 3 different origins of volatility. And there are others too, of course. It's difficult to categorize this. And this is what I am calling them. Volatility is generated from either news or a statistical release. Volatility that is generated from what I call a scenario change, and I will explain that. That's the one I'm going to do first, actually. And then the one that we're all familiar with, the one that's most common, that's a stop-loss run. But first, let's do the volatility from, this is my favorite, actually, from what I call scenario change. At any one time, the market generally has a view. I remember, when I started trading and I was sitting there and I had no clue as to what I was doing, sitting there in a tweed jacket that I'd gotten when I was in college, and I still didn't own a suit yet, so I'm sitting there in a tweed jacket on the Credit Suisse trading desk, an English major. The traders were all looking at me very speculatively, shall we say, such as, what is he doing here? And how did he get here? I didn't tell them immediately that I'd come straight from the front seat of a taxi cab because I used to own and drive a cab, but that's another story. But I didn't really know what was going on. Matter of fact, I didn't know at all what was going on. I'm still amazed that Credit Suisse stuck with me. But one of the things that the older traders there would say, and none of them are old because none of them are over 30, a number of them actually are still here at our firm. We are still friendly and business associates after 20 years. It's kind of cool. But one of the things that the other traders would say to me is, you've got to have a view. I say, a view? What do you mean a view? What they meant, we all know, is there's some basic assumptions that you have about the market at any one particular time. Right now, the basic assumption that's operating, and I'm going to deal with one currency, the euro and the dollar, because you can only deal with one, otherwise we'll be here all day. Which I wouldn't mind, but I don't think I'd get everybody to stay, and I probably don't have enough coffee. Although I did bring in coffee. Right now, we've all seen the dollar get much stronger. If anyone has been following any of the stuff that I write or the appearances that I make, I've been saying this for some time, and the real reason, and the reasons are several. One is that the European economies are terrible, and relatively speaking, the U.S. economy is better. 2, and probably more important, the ECB is coming late to the zero-rate poker game, shall we say, that all the central banks are playing right now. The ante is an effective zero-rate policy. Well, the Fed's had one for, let's take a look at this one. I love this chart. Fed funds, target rate. Since 2008, let's count the years. 1, 2, 3, 4. We're going on 5 years of zero-rate policy. Remember, this is effectively a negative rate. So the Fed's been doing this for 5 years. Let's take a look at the ECB. Okay? They're a little late to the party. We're going to talk about this right here. This is one of my favorite instances of central bank fun and games. So the ECB now, I'm going to go back to the Euro chart, now under Draghi, is moving into the ante-phase, ante as in a poker ante, in the central bank poker game right now. The Fed has been there for 4 years. So the change in the markets are always about change. Very rarely are they about absolutes. They're about change. So the new factor in the market, in the equation for traders between the euro and the dollar, is that it's likely that the ECB is going to continue to lower rates, and then they're going to figure out, if they don't get some growth in Europe soon, and it's not looking very good, they're going to come up with some way to do quantitative easing. That is the new factor in the markets. And Mr. Draghi, over the past month, said the same thing twice. There are no coincidences in the speech of central bankers. He said this twice within the space of a week, I think, in two different situations. One was the last rate cut in the press conference afterwards, and then in a speech, I think. But he said that the ECB essentially stands ready to do more things. Well, what could he be talking about? Obviously, he's talking about more rate cuts, but he's also probably talking about some type of quantitative easing. Therefore, this is a new factor in the market. And we have seen what the euro has done. Now, I could say that this is the same type of scenario change that I'm talking about that I'm going to illustrate here back in 2008. But the one in 2008 is more dramatic. And so I want to actually talk about that now. Let's all go back 4 or 5 years to the summer of 2008, before all of what's been here had happened. The U.S., remember, we're talking now the summer of 2008. Before my kids were born, actually. They were born that fall. The Fed began lowering rates in the last third of 2007 under the flail of the subprime housing crisis in the United States, which, of course, prior to that, Mr. Bernanke said there is no problem. So Mr. Bernanke's analysis is not always so accurate. And some of his assurances now might be taken with the same grain of salt. But at any rate, he did begin lowering rates dramatically from 5, after having raised them all the way. This, of course, the prior period be the extended period of low rates under Alan Greenspan. So the Fed began lowering rates in 2007. A central bank doesn't do a rate decrease like this unless it is really fearful. However, as you can see, this period here, remember we're talking latter of 2007, almost a year, well, about 9 months. Jean-Claude Trichet, the Europeans, and the European Central Bank were basically saying, what me worry. We don't have any of this questionable paper on our books. Either they don't know or they were lying. I find it incomprehensible. I remember, as I think I've told you before, and other people have probably heard this, my wife was working at, I can't name the bank. She was a managing director at a very well-known and famous bank on Wall Street. And she was actually in the asset securitization department, although not in the mortgage backs. And we would talk about it. I'd watch the markets at work, I traded, and we'd talk about finances and international markets when we came home. Not always, but we did on occasion. And she knows, if you read Michael Lewis's book, The Big Short, which is a very funny book, he's a very funny writer, but he's very accurate. She knows many of the people in that book. That's part of the job that she did. She's now not working at all because she's just home with the kids. However, so we would talk about this. And I would come back to her and I'd say, look, the ECB is right here in July, right? The beginning of, that's July 1st. ECB raised rates. Remember, the Fed has been lowering rates since 2007. Why are the Fed lowering rates? Because they want everybody to have cheap money. They're fearful. Anybody could have known this. That's why a central bank lowers rates. They're afraid of growth slowing down, or in this case, they're afraid of Armageddon. Although they didn't quite know it was Armageddon yet. But at that time, Trichet and the Europeans were saying we don't have any problems. Growth is okay. And they raised rates. They raised rates in the middle of 2008. What happened at the end of 2008? But anyway, in the middle of 2008, it's my favorite central bank move. They raised rates. Did the Europeans and Mr. Trichet and everyone else really believe? I mean, they've heard of the internet. That there were going to be no problems in Europe? I don't know. I'm not Mr. Trichet's pen pal. On the other hand, did Mr. Bernanke really believe that the subprime problem was contained? Apparently he did. So, remember, the people who are running the world are as fallible as everybody else. So anyway, ECB raises rates here. What does the euro do? Well, that's pretty easy. Let's take a look at the euro. Whoa! Here we go. The euro steadily rising. Why? The U.S. is having all these problems about subprime. The U.S. is not looking great. So the euro gets stronger and stronger, up to over 1.6. So what happened here? The peak here was 60.38, July 15th. And then this. Now this is long before. Remember, Lehman and all that stuff happens right about here, towards the end of the year. This fall started before that. And what caused it? Now, if we look at the refi rate, they don't reduce rates until October 7th. The fall in the euro begins here in July. So it's July to August, September, 3 months before the euro starts to fall. So what happened? And I remember it very well. The scenario changed. What had been going on here is that the euro, the European area, the EMU, is going to remain immune from what's going on in the United States. This is a universally unrealistic idea, but it was very much what the Europeans and the ECB was saying. I remember telling my wife, you know, Mr. Trichet is saying that we don't have any banking problems here. And my wife looks at me, she goes, what are they talking about? We sold billions of this paper that was causing problems in the United States already to the Europeans. Their banks were stuffed full of it. So did Mr. Trichet not know? I don't know. I don't really know. I never spoke to him. He probably wouldn't speak to me if he met me. He certainly wouldn't know who I am. So the question is, did the ECB really not know? Or were they willfully, shall we say, closing their eyes to it? I don't really know. I don't know the structure of the ECB and their bank regulation over national entities. My guess is by now, after all that the ECB has had to do since 2008, they would know. But it's quite possible that in that initial euro euphoria phase that the euro was very much in, it was a huge success when it was launched, that they didn't know, or they didn't look too hard. Remember, this is the period, too, where Greece ruthlessly, with the help of Goldman, fudged its criteria for getting into the euro, and the idea that the ECB and the other governments didn't know is preposterous. They simply looked the other way because they had a political goal. They wanted they wanted the Greeks in. Anyway, so this scenario here was based on the idea, and this stronger euro was based on the idea the U.S. is having problems, Europeans not. Trichet raises rates. So what happened there? I don't remember the exact date. What happened was that the ECB came out and they said, growth is not going to be as good as we think. That's all they said. But what it did, in effect, now, not that do you think there weren't doubts among traders' minds about this stuff? Traders, are skeptical people. They have to be, otherwise they're out of business. Financial people are skeptical people, and they're always looking for the danger. So, was this some sort of universal idea that everybody believes that the Europeans are not going to have problems? No. It's much like the stock market right now today. Same idea. If the market's going up and it looks like it's going to keep going up, you as a trader participate. Does anybody take equity traders right now? 9 days in a row, the S&P sets an all-time record. GDP was 2.5 in the first quarter, and the first quarter is probably going to be 1.5 in the second, and remain that way. Does this sound like an equity market that should be at all-time highs 9 days in a row? No, of course not. But is that relevant? Only partially. Because there's plenty of reason, internal trading reasons, for the market to go higher. It's known as the Fed. And until that changes, traders will participate. After all, a trader's job is simply to make trading profits. It's not to pass judgment on whether the market is behaving rationally or irrationally. It's irrelevant. So a lot of that was going on here too. So in this particular type of change, volatility that I call scenario change, that one statement by the ECB, that growth is not going to be as strong, precipitated a huge reaction in the euro. Because it completely, even though it was a very modest statement, first of all, if a central bank that has been touting its immunity or the immunity of its area to problems elsewhere in the world, you know that if they're getting worried, then they're only saying a little bit, only giving you a tip of their real concern. And that's a realistic, plus markets always overshoot. So this enormous change here, look at this, whoosh, wham. That's a technical term, charting, wham. Was because that one statement, now it took a couple of days for this to sort of percolate through. And of course, as you can see right here, it's a major technical break here, all sorts of other things. But the basic change here is a change in a scenario. It's a change in the market's view. And it was precipitated by a very small comment. But that comment contained a truth against the scenario. So that's the first type of volatility that I call scenario change. Those kinds of volatility, volatility generated in that way means it's time to take a different view of what's happening. The basic underlying assumptions, and this happens all the time. Markets always have an assumption, and then this assumption always changes. And if you get this right, then you will know that there's not going to be any bottom picking on this move, or at least only in a very, very limited sense. This is a move where everybody's going to get on board, and it's going to accelerate, and that's exactly what happened. Because the calamities remember, Bear Stearns was the early part of the year over in March, right? So Bear Stearns had already happened. Lehman wasn't until over here in October. So this move here is the scenario change in Europe. Okay, now we have something similar to that going on right now. I don't actually have a chart for it, but I'll just tell you. And it had to do with what I was speaking now about recently about the ECB. Mr. Trichet's two statements that the ECB, will act if they have to, is a scenario change item. And you've seen the reaction in the euro rates. Yes, it's bumpy on the way down, but it's been pretty steady. I came in yesterday and I was a little surprised that it had moved so quickly. It actually had gone down to 128. So that's one type. Okay, let's do the next type because I really do want to get to these. I want to get to them quickly. The one that's most common is the one that we see all the time. And this is just these are just stop-loss runs. Now, there are two different kinds of stop-loss runs that I'm going to illustrate. Okay, these are the ones we see all the time. Okay, that was Thursday. That's the less common kind. Okay. Let me see. Maybe it's the euro I've got it on. Yes, it's the euro I've got it on. Hang on. Okay. Oops. Sorry. Oh, here we go. This one. Okay. Now, this one. Okay. We all work by technical trading. As I spoke about earlier, the market is made of, all of us sitting around trying to do the same thing. We all look at the same information, and most of the time we come to the same conclusion. One of the most common type of stop run is one where a simple range or level has been transgressed. And this is the May 2nd in the euro. Now, we see what had happened here, right? We all know this. And very often you get moves like this around big figures, or around zeros. 31.50. The Japanese love this. I'm going to illustrate another one. Okay. I do expect USD strength to continue for the rest of the year. Yes, I do. The US, however the performance is between the U.S. and Europe, Europe's in recession. The U.S. is not. Outside of an exogenous shock, and the ECB has told us that they're ready to do more. Does that mean they're not going to? No, it means they are going to. And what are they going to do? Well, what can they do? They can't create jobs. All they can do is flood the market with money. Every central bank is doing the same thing because that's all they can do. They can't rationalize markets. They can't create demand. The Fed is desperately trying to by driving the stock market up. We're spending $85 billion a month basically to drive the stock market up because it's supposed to have a wealth effect. That's what's going on. It's not much more complicated than that. It's not spoken about often in such direct terms, certainly not by the bankers, but that's what's going on. So the ECB is about to join that crew in some fashion or other. The central bank posse, the central bank liquidity posse. Is posse still a popular term? Probably not. I'm very disconnected from popular culture, so I actually wouldn't know. My kids aren't old enough to ask yet, but soon they will be. I'll dread that day. Okay, so right here, 31.50. One attribute, maybe the chief attribute of a typical stop run, one that is based solely in internal market movement, is it returns. Okay, above 31.50. Couldn't hold it. We get here. You can see how it accelerated before. These, by the way, are, if I remember, there's a 30-minute chart. Okay? So it runs from here down to here, which is about 30.70. This is at the figure run, if I remember. It's 31.70 to about 30.70. Okay? One shot run, 30 minutes, get out of the way. What happens, and this is the typical sign of this type of stop run, when the stops are executed, the market stops. It is the execution of the movement. It's not a change in scenario. The ECB didn't suddenly lower rates. It's that these people here who were hoping, who bought it up and wanted it to go higher, realize it is not going higher, and if I don't get out, I'm going to either lose money or lose all my profits or start losing money. So they all get out at the same time. They all look at the same charts. They could see that it went above 31.50 here, stayed above it, tried 1, 2, 3, you could say 4, you could say there's 1, 3 tops, whatever you want from a technical point of view. Everybody looks at this ain't happening. One last attempt here, and it failed. It would have to have gotten above that point for it to continue. It didn't. Ran out of steam. Whack. Came off. Another technical term. Whack. But the attribute of this is that gold is interesting, but I'm not going to have time to get to it today. The attribute of this is when the stops are done, the market stops, and most of the time it creeps back to the same level. Because what happens in an execution like this is that there's actually not a lot of trading that goes on in that stop run. There isn't a lot there to absorb it when it comes back. It's the old market cliche about gaps get filled. Same thing. So this is the type of stop run that obviously you can trade. It's risky, of course, because you don't know if there are more stops, but what's not risky in trading? But once it goes here, you have a reasonable chance that it's going to go back because the basic scenario behind the market at this time hadn't changed. There was no news out. Nothing really changed the market's view. It's just that for this period right here, it hadn't gone higher. And so everybody here got out. That's one type of stop run. That's the most typical. That happens all the time. That's the kind we all trade. That's the kind of stop run or movement that you see at the tops of channels, the bottom of channels, and all of the candle chart reversals that you see. Okay? Now, this is yen. I know we're getting close to running out of time here. This is a different stop run, and this is one which is a lot more dangerous. Okay? Now, this is last Thursday. Remember, yen hadn't been at 100, I think, in 4 years. Some ridiculous amount of time like that. Now, this is one that gives bank traders nightmares. This is a minute chart. A minute chart. The other one was a 30-minute chart. This is a minute chart. Oh, I've sat through things many times. Now, if you look at, let me give you okay, where's the 100 level here, right? You can see the amount of pressure applied and rejected from early April for a month. The yen butted up against 100. And this is, of course, under the scenario, which is, there's a scenario change down here, but I don't want to talk about it, of Mr. Abe running for office. That's a scenario change down here. It's not as dramatic. I don't have the exact date when it took place, when he first said, if I'm elected, elect me and I will flood the market with yen. He didn't say that. I don't know. See what it sounds like. Sort of. G7 now is kind of old hat. You know, I don't think the G7. There was a time where G7 announcements actually could move the market. I don't think everybody pays much attention to them anymore, but it's still possible. I mean, there is some truth to what you're saying because the G7 did not say anything about the Japanese weakening their currency, and nobody thought they were going to, so it wasn't much of an event, but it could have been. I mean, I suppose they could have come out and said, you know, the G7, we deplore the mercantilist currency policies of Japan. And then you would have a problem. That would have gone the other way, but that's not what happened. Anyway, so this move is the move we're talking about right here. So you can see the background. Every bank trader on the planet, perhaps in the solar system, had stops just above 100. Everybody. Many of them were large. Because we hadn't been there for a long time. So, some of them were to go long. Some of them might have been to cover shorts, although I doubt there were too many to cover shorts. I think most of them were probably to go long. They're going to be option related. They're going to be traders. There's going to be all sorts of buying that these poor bank traders had to do at 100. Now, everybody in the market knows this. Everybody. You look at your own book, you know that there's nothing unusual about it. I don't suppose I can get an extra 5 minutes. This is a really good one. Can I? Or is somebody on next? Sorry, folks, I'm asking, I think it's Vicky, but it could be Maud. Anyway, let me do it quickly. So, what happened here, and I spoke to traders about this, remember this last Thursday, is that everybody know there are huge stops right here, just above 100. The traders are all sitting there frozen to the desk because they know they're going to have to execute. What happens when a trader has to execute? He's got to buy $50 million or $100 million or 400 in the space of 10 seconds, 5 seconds. This is really nerve-wracking. Believe me. I've done it many times, although not recently because I don't do it anymore. So what was going on here is we think, now there's been no guarantee of this, that hedge funds, guys who are willing to put on big risk know this. So what are they doing? Look at these two moves. This one took place in about 15 or 20 minutes, maybe a little more, maybe half an hour. Somebody, and right down here, we're well below the stops. We're at like 98.50, 98.60, 98.70. But somebody in a certain amount of time forced the market up to here. And you can do that. If you're willing to put on a couple of $100 million in a position, you can do that. So they force it up here, they stop buying. But everybody on the trading desk is getting more and more nervous. They know that if it gets up here, they're going to have to execute this stuff, and they're going to have to do it in a flash. So again, we tootle along for a while, nothing happens. Somebody does the same thing. Drives it up. These were very unlikely to be internally generated market moves. There was somebody pushing for an inflection point. Knowing that, remember, somebody bought this up here. Somebody went long. They might have gotten long $300 or $400 million down here. They might have gotten long 200 down here. They're long half a yard. If they can push it through, they started buying a figure and a half below. Market works like this. So all of these poor traders, of whom I used to be one, are sitting right here at 99.70. And they know that if this goes any further, they're going to have to buy 300 million or however much it is. That's really, really hard to do. So what do? When it gets right here, they buy in front of it. They have to. And that is what drives a move like this. This, I think, was 70 points in 1 minute. It's the kind of stuff I used to consider fun after it happened. But this, again, is the product of a stop put on top of a scenario change. This one doesn't come back. Okay, folks, I'm about to be shut down, as usual. I thank you all very much for attending. I hope this was useful. I did not get to the last kind, the last type, what did I call news and statistical releases, but it's very similar to what I've spoken about. I will put my email address in there if anyone would like to talk to me about this, or send me an email. I'll be glad to talk to you about it. Maybe I'll do this topic again for my monthly seminar next month, because there's more to do about this, and I find it an absolutely fascinating topic. If you can explain volatility and how it comes from to a trader, they then understand and know what to look for. Again, thank you very much for attending. I hope it was useful, and I hope it was a little bit fun, although I'm not known to be able to tell jokes. Thank you very much. Bye-bye.